Welcome to the deep dive. We're here to cut through all that noise, the flood of data you get, especially from financial reports. Today, our mission is basically to give you a shortcut to understanding what's really going on, pull out those surprising facts, those aha moments, without you having to wade through everything yourself.
Exactly. And today we're jumping into Travelers' second quarter results for 2025. They look, well, pretty excellent on the surface. We've combed through their official press release and, importantly, their detailed 10Q filing with the SEC to get the full picture.
Right. So the goal here is to really unpack these numbers, get past the jargon, and figure out what actually drove these results, and maybe what it tells us about travelers and, maybe even the wider insurance world. So let's get started.
Okay, Travelers just reported, and honestly, the top-line figures are pretty staggering. For Q2 2025, net income per diluted share hit $6.53. That's up, 185% from last year? Just massive. And maybe even more telling, their core income per diluted share jumped 159% to $6.51. I mean, that's almost triple their operational profit year over year. It really is an impressive leap. And it's worth pausing on that core income number for a second. Net income includes all sorts of things, investment gains or losses that can swing wildly. But core income, that strips some of that out and gives you a much clearer view of how the actual day-to-day insurance business is performing. So seeing that number jump so dramatically, it really points to strong underlying operational health. And you see that reflected in the return on equity, too, up to 20.9%, and the core ROE hitting 18.8%. Very efficient.
Okay, incredible efficient. So what were the kind of main levers they pulled? What really drove that core income surge?
Well, it wasn't just one thing. It was sort of a confluence of factors. A big piece was definitely lower catastrophe losses compared to last year's Q2. That helps a lot. They also saw a higher underlying underwriting gain, basically, making more profit from writing insurance policies, even before you consider catastrophes or reserve changes. And speaking of reserves, they had increased net favorable prior year reserve development. We can dig into that more. Plus, higher net investment income gave them a boost. Oh, and that underlying underwriting gain. It was also helped by just doing more business, higher volumes. And just to round out the picture on overall net income, they actually had net realized investment gains this quarter, whereas last year they had losses, so that flipped too. Right, okay. Lots of moving parts there, all seemingly moving in the right direction this quarter. Let's talk about the combined ratio. Always super important in insurance, right? Tells you if they're making money on the insurance itself. Under 100% is good. Travelers' consolidated ratio improved, really dramatically, down 9.9 points to 90.3%. That's down from over 100% last year. What was behind that big improvement? Yeah, that 9.9 point drop is quite something when you break it down. The biggest piece, 6.2 points of that improvement came directly from those lower catastrophe losses we mentioned. Just less severe events hitting the bottom line this specific quarter. But critically, 3.0 points came from an improvement in what they call the underlying combined ratio. So that means their core ongoing business operations got more profitable, separate from the storms. And last bit, 0.7 points, came from that favorable prior year reserve development, basically finding savings on old claims.
Okay, let's linger on catastrophes for a moment. They're always the wild card, aren't they? So Q2 saw a big drop, $927 million pre-tax this year versus over $1.5 billion last year. Mostly wind and hail, the report says, but you hinted earlier it's not quite the full story for the year so far.
Exactly. It's crucial to see both sides here. That quarterly drop was a huge relief, no doubt. But, insurance planning is tough with this stuff. Because if you look at the first half of the year, year to date, catastrophe losses were actually higher than last year. $3.19 billion in the first 6 months of 2025 compared to $2.22 billion in the first half of 2024. That includes things like those California wildfires back in January and other storms from Q1. So yes, Q2 was better, but the overall trend this year still highlights just how volatile and unpredictable these major events are for insurers.
Right. So a good quarter for cats, but the year is still showing the pressure. Now, you mentioned the underlying combined ratio improved significantly to 84.7%. Why is that specific number, stripping out the cats and reserve changes, so important for us to understand?
Because it's arguably the best measure of their core operational health and discipline. It shows how well they're pricing risk, managing claims, controlling expenses in their day-to-day business before you factor in the big unpredictable events like hurricanes or major reserve adjustments from years ago. Seeing that improve by 3.0 points down to an excellent 84.7%, that signals that the fundamental business is running really well. It suggests sustainability.
Okay, that makes sense. And you also mentioned favorable prior year reserve development. It sounds complex, but you said it was a positive. Can you just unpack that a bit more?
Sure. It sounds technical, but it's actually pretty straightforward. And yes, definitely a good sign. It just means that travelers looked back at the money they had set aside for claims from previous years and found that those claims are actually costing less than they originally estimated. Maybe settlements were lower or fewer claims materialized, so they could release some of those reserves, which flows through as a benefit to income. In Q2, that benefit was $315 million pre-tax. What's really encouraging is that this happened across all three of their business segments. It wasn't just one area. That suggests pretty solid claims handling and initial reserving across the board.
Gotcha. So strong underwriting, helped by lower cats this quarter, and good news on older claims. But insurance isn't just about underwriting, right? They manage huge investment portfolios. How did that side of the house do? Net investment income was up 6% after tax in Q2. What was behind that?
Yeah, the investment side is crucial too. That 6% increase was driven mainly by two things. One, they simply had more money invested. Their average invested assets grew. And two, they were getting a higher average yield, particularly on their long-term fixed income holdings. And they seem pretty confident looking forward. They're projecting after-tax net investment income from fixed income to be around $770 million in Q3 and then $805 million in Q4. Solid numbers.
Okay, sounds positive. But I also saw mention of net unrealized investment losses. The number looked pretty big, $3.83 billion pre-tax. Losses always sounds worrying. Should we be concerned about that?
That's a really important distinction to make unrealized. You're right to ask, but no, it's not the kind of loss that impacts their day-to-day operations or cash flow, generally speaking. These are basically paper losses, primarily reflecting where interest rates have moved. Think of it like the value of bonds they hold has gone down on paper because newer bonds are being issued at higher rates. But Travelers doesn't plan to sell most of these bonds before they mature. They expect to receive all the promised payments, the contractual cash flows. So unless they're forced into selling early, which is unlikely given their strong liquidity, these aren't realized losses hitting their P&L in the same way. Their strategy is pretty standard, really high-quality, diverse portfolio, mostly U.S. government, municipal, corporate bonds, and they keep the average duration relatively short, about 4.6 years right now, which limits some interest rate risk. So, short answer. It reflects market conditions, not a fundamental problem with their investments or liquidity.
Okay, that clarifies things. Good to understand the difference between realized and unrealized. Let's zoom in on the business segments now, see where the action really happened. Overall, net written premiums hit a record $11.543 billion, up 4%, and growth in all three segments. How did business insurance do?
Business insurance had a solid quarter. Segment income was up $157 million to $813 million. The drivers were pretty much what we've discussed overall. A better underlying underwriting result, that favorable prior year reserve development helped here too, $79 million worth, higher investment income, and slightly lower cat losses, $368 million for this segment. And premiums grew nicely too, up 5% overall for business insurance. What really stood out was the middle market business within that segment that grew a strong 10%.
Okay. What about bond and specialty insurance? What's the story there? Seems like a different kind of beast.
It's a bit different, yeah. It also had a good quarter, income up $74 million to $244 million. The really notable thing for bond and specialty is how little it's usually impacted by catastrophes. This quarter, cats were tiny, just $5 million, lowest across the company. And its combined ratio was very strong, 80.3%. Makes sense, given the low cats. But here's a little nuance. Even though the overall result was strong, the underlying underwriting gain actually dipped slightly. That was due to a mix of pricing factors and higher G&A expenses, although higher business volume helped offset some of that. And the favorable reserve development in this segment mostly came from their fidelity and surety lines. So, specific strengths there.
Interesting nuance. Okay, now for what seems like the biggest story this quarter. Personal insurance, home and auto. This segment went from a $153 million loss last year to a $534 million income this Q2. That's a massive swing. What on earth happened there?
Yeah, that turnaround is really remarkable. It was a huge contributor to the company's overall great quarter. Two main things drove it, and one was absolutely those catastrophe losses. Personal insurance cat losses were $554 million this Q2 last year. Over $1 billion, $1.08 billion. So a huge drop there was key. But it wasn't just luck with the weather. Their underlying performance improved significantly too. The underlying underwriting gain improved by a strong 7.2 points. They said that reflected better pricing coming through, lower losses in auto specifically, and also fewer non-catastrophe weather losses in homeowners. So better core performance. All that brought the personal insurance combined ratio down a whopping 20.1 points to a profitable 88.4%. Net written premiums for this segment were up 3% overall. Homeowners' premium changes were strong. even though auto premiums dipped slightly, so a really significant turnaround story there.
Wow. Okay, so strong operations, strong turnarounds. What about the overall financial health? Capital position, returning money to shareholders?
Yeah, they look very solid there. They returned $809 million to shareholders just in Q2. Most of that, $557 million, was through share repurchases, plus they declared their regular quarterly dividend, $1.10 per share. Shareholders' equity itself grew 6% since the end of last year, up to nearly $29.5 billion. And their liquidity at the holding company level looks very comfortable, $1.97 billion, which well above their target of $1.36 billion. Debt-to-capital ratio, if you exclude those unrealized investment losses we talked about, is 19.8%. That's comfortably inside their target range of 15% to 25%. So all signs point to a robust financial foundation.
And they made a pretty big strategic move recently, too, selling off most of their Canadian business.
That's right. End of May, they announced a deal to sell most of their Canadian personal and commercial insurance operations to Definity Financial. The price tag is about US $2.4 billion. They're keeping their surety business in Canada, but the rest is going. That sale is expected to close sometime in the first quarter of 2026. It definitely seems like a move to streamline and focus their resources, probably on the U.S. market primarily.
Okay, one last area to touch on: asbestos claims. These always seem to linger for insurers. The report mentions something interesting. Conventional actuarial methods are not utilized for these reserves. What does that mean, and how are they managing this?
Yeah, asbestos is a long-standing, tricky issue. The report notes it's still influenced by things like lawyer advertising, finding new claimants, or focusing on different types of companies as defendants, which can push settlement costs up. The reason they say conventional actuarial methods aren't used is because the ultimate cost and timing of these claims are just incredibly hard to predict. It's not like car accidents where you have vast historical data, the latency, the changing legal environment. It makes standard forecasting methods unreliable. So the reserves they set aside are subject to potentially significant future revisions, up or down. It's just inherently uncertain. However, for what it's worth, their net asbestos reserves actually held steady at $1.24 billion as of June 30th, and the actual amount they paid out in losses decreased compared to last year. So while the uncertainty remains, the current situation seems relatively stable for them.
Right. Still a challenge, but maybe contained for now.
Yeah.
So wrapping this all up, it feels like Travelers delivered a really exceptionally strong second quarter, driven by, yes, lower catastrophes quarter over quarter, but maybe more importantly, really solid underlying underwriting, especially that big turnaround in personal insurance, plus good investment income. And their capital position looks very strong, supporting buybacks and dividends.
Absolutely. A combination of operational discipline, some favorable conditions in Q2, and strategic adjustments really paying off. It showcased strong management across the board.
So thinking beyond just Travelers, if we look at how they navigated this quarter, managing the unpredictable stuff like catastrophes while also improving the core business, what's maybe the key strategic lesson here? What could other companies, maybe even outside insurance but facing similar volatility, learn from this?
That's a great question. I think it really highlights the critical importance of focusing relentlessly on what you can control: your underlying operational efficiency, your pricing discipline, your expense management, especially when the external environment is so unpredictable. Travelers showed how strong core operations can help absorb shocks, like higher year-to-date catastrophes, and still deliver strong results when conditions ease up, like they did in Q2. Strategic asset management matters too, of course. It really poses the question, in an increasingly volatile world, how much resilience comes down to just mastering the fundamentals.
Mastering the fundamentals amidst the chaos.
Yeah.
Definitely something to think about. What parts of this deep dive stood out most to you? Consider that as we wrap up. Thanks for joining us for this deep dive into Travelers' Q2 numbers.